Let me tell you about a man I'll call Robert. Robert was 53 years old, sitting at his kitchen table on a Tuesday morning in March of 2009, staring at a brokerage statement. His hands were shaking, not from old age, but from fear. He had watched his retirement account drop from $410,000 down to $212,000 in the span of 18 months. And that morning, he made a decision he had been fighting for weeks. He picked up the phone, called his broker, and said 3 words: sell it all. He slept better that night than he had in months, and that decision, that one quiet moment of relief, cost him the retirement he had spent 30 years building. Because what Robert didn't know, what nobody told him clearly enough, is that the market bottomed out the very next week. By 2013, it had fully recovered. By 2019, it had more than tripled. The account he sold at $212,000 would have been worth over $1 million a decade later. He sold the greatest buying opportunity of his lifetime because it felt like the right thing to do. It felt safe. It felt rational. That feeling, that is the enemy. Not the market, not the economy, not the government. And here's the uncomfortable truth I want you to sit with today. Most of the financial damage done to ordinary Americans is not done by Wall Street. It's not done by bad stocks or corrupt companies or rigged systems. Though those things exist, most of the damage is self-inflicted. It's done in quiet moments at kitchen tables, in the middle of the night when fear gets louder than reason. It's done by people who are smart, hardworking, well-meaning, and completely unprepared for the psychological warfare that comes with building long-term wealth. Nobody teaches you this. Not in school. Not in most finance books. Not in the headlines that scream at you every single morning. They teach you compound interest. They give you charts. They explain diversification. But they never sit you down and say, your brain is going to betray you. Your instincts, the very instincts that kept your ancestors alive, will cost you money. And unless you understand that deeply, none of the math in the world will save you. So that's what we're going to talk about today. Not stocks, not formulas, not tips. We're going to talk about what actually goes on inside a person's mind when money is on the line, and why the investors who win over the long run are almost never the smartest people in the room. They're the ones who learn to manage themselves. Let's start here. You work hard. You save. You finally get some money invested. Maybe it's in a 401. Maybe it's in an index fund. Maybe you've done some research and picked a handful of solid companies. You feel good about it. You feel like an adult making adult decisions. And for a while, everything is fine. Then something happens. Could be a recession. Could be a pandemic. Could be a war, an election, a banking crisis, an inflation report. It doesn't matter what it is. Something happens, and suddenly the number on your screen is smaller, a lot smaller. And the news is on, and every anchor is using the word catastrophic. Social media is full of people predicting the end of everything. Your brother-in-law calls and says he already got out 3 weeks ago. And now that number on your screen just keeps going down. I want you to feel that, really feel it, because that is the moment. That is the exact moment that separates the people who build wealth over a lifetime from the people who never quite get there despite doing everything else right. And it is not a moment of intelligence. It is a moment of character. Here's what your brain does in that moment. It shifts into survival mode. This is not a metaphor. It is a neurological event. The part of your brain responsible for long-term reasoning, for patient or abstract thinking about the future, it goes quiet. And the primitive part, the part that is wired to respond to immediate threat, takes over. That part doesn't know the difference between a bear market and an actual bear. It just knows danger. Get out. Move. Survive. And so you rationalize it. You tell yourself you'll wait until things calm down and then get back in. You tell yourself this time is different. You tell yourself you're being smart, being cautious, protecting what you've earned. And every single one of those thoughts feels completely reasonable. That's the terrifying part. The fear doesn't feel like fear. It feels like wisdom. This is what I mean when I say the psychology of money. It's not about greed, though greed plays its role too. It's about the way our minds construct stories around numbers and how those stories drive decisions that compound over decades into wildly different outcomes. Two people with identical incomes, identical savings rates, identical investment choices, if one of them learns to manage their psychology and the other doesn't, 20 years later, they will live completely different lives. Not because of market timing, not because of stock picking, because of behavior. Let me give you another picture. Think about a woman, let's call her Carol, who started investing at 28. Nothing fancy. She put money into a basic index fund every single month. $200 when she was young and broke. $500 when she got promoted. $1,000 after her kids left home. She didn't watch CNBC. She didn't have a sophisticated strategy. What she had was one rule she made for herself and never broke. She would not look at her portfolio during a down market. She would not check it when the news was bad. She would keep contributing, close the app, and go live her life. People thought she wasn't paying attention. Her colleagues said she was naive. Her husband once suggested they move some money to cash, just temporarily. She said no. She kept going. At 65, Carol retired with $3,400,000. No inheritance, no lucky stock picks, no inside information. She just refused to let the noise become signal. Now, I'm not saying Carol had no fear. I'm saying she had a prior agreement with herself about what to do with that fear. She decided in advance, in the calm, rational daylight, how she would behave when things got dark. That is the work. That is the unsexy, underappreciated, never talked about work of long-term investing. Because here's what we almost never acknowledge. It's easy to have a strategy when the market is going up. Everybody's a disciplined long-term investor in a bull market. The real strategy, your real strategy, is revealed the first time you're down 30% and you haven't slept in a week. That's when you find out what you actually believe about investing. That's when the philosophy you said you had either holds or it doesn't. And this is the part that should make you a little uncomfortable. Not because you're a bad person or a careless investor, but because most of us, if we're honest, have not done the work of constructing that prior agreement with ourselves. Most of us are relying on willpower in the moment of maximum stress, and willpower in the moment of maximum stress is the most unreliable resource in the human experience. Think about that for a second. We know this about every other area of life. We know not to go grocery shopping when we're hungry. We know not to send an email when we're angry. We know not to make major life decisions in the middle of a crisis. We've internalized those rules about relationships, about health, about almost everything. But somehow with money, with the thing that represents decades of labor and the security of our families, we still think we can just wing it. We think we'll figure it out when we get there. And then we get there and we do what Robert did. We sell everything at the bottom and we call it a strategy. Here's the quiet truth: the financial industry doesn't have much incentive to tell you volatility is not risk. I'll say that again because it matters. Volatility is not risk. A temporary drop in the price of a fundamentally sound asset is not a loss unless you sell it. The number going down on your screen is not money you've lost. It's a price someone would pay you today if you wanted to sell. And if you don't want to sell today, and you won't need to for 15 years, then that number is mostly irrelevant. What matters is where it goes over time. Risk, real risk, is the permanent destruction of capital. Real risk is buying something that was never worth what you paid for it, or being forced to sell at the wrong moment because you didn't structure your financial life to give yourself time. Real risk is running out of money in your 80s because you were too cautious in your 40s. Those are the risks worth thinking about carefully. A market correction that happens every 5 or 6 years like clockwork, that is not the thing to fear. That is the price of admission. The market has gone down and come back every single time in American history. Every panic, every crash, this time it's different moment. The people who held, the people who kept buying if they could, they came out on the other side. Every time. Not because they were lucky, because they understood something fundamental. The long arc of a productive economy bends upward, not in a straight line, not without pain, but upward. Now I want to talk about the other side of this, because fear isn't the only emotion that costs people money. Greed does too, but it's sneakier. Greed doesn't announce itself. Greed shows up wearing the costume of a reasonable, intelligent decision. Think about the person, and most of us have been this person at some point, who sees an asset go up 50% and thinks, I missed it. I should have been in that. And so they get in at the top. And then when it corrects, which everything eventually does, they hold it because they don't want to admit the mistake. And then it goes lower and they hold it some more because now they're waiting to get back to even. And years go by. And that capital, which could have been quietly compounding somewhere else, is frozen hostage to an ego that couldn't handle acknowledging a bad entry point. That is not a story about one unlucky investor. That is a story playing out right now in millions of accounts. The technical term for it is loss aversion, the psychological reality that losing something feels roughly twice as painful as gaining the same amount feels good. Which means we are not rational about money. We are deeply, consistently irrational. And the market, in its cold and efficient way, exploits that irrationality constantly. The cure, and there is a cure, is not trying harder to be rational in the moment. The cure is removing the moment from the equation as much as possible. It's automation. It's rules you follow without reviewing. It's the decision to invest a fixed amount on the first of every month regardless of what the market is doing, regardless of what the news says, regardless of how you feel that morning. It's boring. It's unsexy. It has made more ordinary people wealthy than any other strategy in the history of personal finance. Time. That's the real asset. Not money, time. Money is just the vehicle. Time is what makes the compounding work. And here is the devastating irony of our relationship with money. We treat time as though we have all of it, and we treat market fluctuations as though they're permanent, when the reality is exactly the opposite. The fluctuations are temporary. Time, your time, the runway you have to let your money work, that is finite, and it is running. Every year you wait to start. Every year you pull out. Every year you sit in cash because things feel uncertain, and things always feel uncertain. That is a year of compounding you will never get back. Not because of what the market did that year, because of what the market would have done in the decades that followed on the money you didn't have working. This is the conversation I wish someone had with me earlier. Not the conversation about which stocks to buy or what percentage to put in bonds. The conversation about identity, about who you are going to decide to be as an investor. Because here's what I've learned after a very long time watching people build and destroy wealth. Your investing results are not a reflection of your intelligence. They are a reflection of your relationship with uncertainty. And if you haven't examined that relationship honestly, if you haven't sat with the question of how you actually behave when things are hard, not how you think you would behave, but how you actually behave, then no financial plan, no matter how well constructed, will save you from yourself. So let me offer you a few shifts, not tips, not tricks, shifts in the way you think. The first is this: stop measuring yourself against the market's short-term moves. The market's job is not to validate your decisions. It goes up and down for 10,000 different reasons, most of which have nothing to do with the quality of your choices. If you bought a solid business at a fair price and the market drops 20% next month, that doesn't mean you were wrong. It means the market is doing what the market does. Evaluate your decisions on the logic behind them, not on what happens in the next 90 days. The second shift is this: build what I think of as a financial identity before you need it. Decide right now, in writing if you have to, what kind of investor you are. Write down your strategy. Write down what you will do when the market drops 30%. Write down how long your time horizon is. Write down the conditions under which you would sell something, and make sure those conditions are logical, not emotional. Then, when the moment comes, and it will come, you're not making a decision. You're executing a plan you made when you were thinking clearly. The third shift is the hardest one. It requires genuine humility. Stop trying to be clever. Stop looking for the edge. Stop watching the people who got lucky last year and trying to reverse engineer their genius. The overwhelming evidence, decades of it, studied exhaustively, shows that the vast majority of individual investors who trade actively, who try to time the market, who jump in and out chasing returns, underperform a simple, boring, diversified portfolio held for the long term, not by a little, by a lot. The cleverness costs them. The activity costs them. The conviction that they see something the market doesn't, that costs them most of all. Humility in investing is not a weakness. It is the most profitable mindset available to you. The admission that you don't know exactly where the market is going next month, but that you trust where the economy is going over the next 20 years, that admission is worth more than any stock tip you will ever receive. And here is where I want to leave you. Somewhere right now, there is a 25-year-old who just opened their first investment account. They're a little nervous. They don't know much yet. And they're going to make some mistakes. That's inevitable. But if someone sits them down and tells them the truth, that the math is simple, but the psychology is hard, that the returns will come if they stay patient, that the real skill is not in picking, but in holding, that their worst enemy in this process is the frightened version of themselves in a down market. If someone tells them that clearly enough that it sticks, that 25-year-old has a real shot at something extraordinary. Not extraordinary in the flashy sense. Not yachts and magazine covers. Extraordinary in the quiet sense. The kind of extraordinary where at 65 you can look at your grandchildren and know, without question, that your family will not struggle the way maybe your parents did or their parents did. The kind of extraordinary where money stops being a source of anxiety and becomes what it was always meant to be, a tool that gives you choices. That is what is available to you right now. Not because the market is going to the moon next week. Not because there's some secret the wealthy know that you don't. Because time and discipline and emotional control, applied consistently over decades, produce outcomes that look almost magical from the outside, but are completely, boringly logical from the inside. Wealth is not built in the moments of excitement. It's built in the long, quiet stretches of staying the course when everything in you wants to do something, anything, just to feel in control. It's built in the decision to trust the process more than the panic. To trust the long view more than the news cycle. To trust your future self more than your frightened present one. The market will crash again. That is a certainty. It will feel worse than you expect. People will say this time is different. Some of them will be very smart people with very detailed arguments. And you will have a choice, the same choice Robert had at his kitchen table, the same choice Carol faced quietly over and over again across 37 years of investing. You can let the moment define your strategy, or you can let your strategy define the moment. That choice, made correctly and consistently, is the entire game. That's all it ever was.